Introduction and historical context. Back in the 1950s, a sociologist named Alfred Winslow Jones had an idea that would change investing forever. He wasn't a Wall Street banker or a stockbroker. He was a thinker, and what he created was the very first hedge fund. Now, what does hedge actually mean? Well, simply put, it means protection. It's like when you buy a plane ticket with travel insurance. If the flight gets canceled, you lose the ticket, but the insurance pays you back some of that money. Jones applied this idea to investing. He placed bets on companies he believed would succeed, and at the same time, bet against companies he thought would fail. The goal was to balance the risk, no matter which way the market moved. Fast forward to today, and hedge funds have become, well, pretty much the opposite of what Jones intended. They're often high-risk deals behind closed doors, where only a select few are allowed in. Learning something new? Hit like and subscribe. We've got more coming on how hedge funds really work behind the scenes. Modern hedge funds and regulation origins. Modern hedge funds are private investment vehicles reserved for the ultra-wealthy. They're exclusive, lightly regulated, and can pretty much do whatever they want. But to understand how that's even possible, you first have to know how the government tries to protect you from going full degenerate and blowing up your life savings. And it all goes back to the 1920s. The US economy was booming. Companies like Ford revolutionized manufacturing with the assembly line, which meant faster production, cheaper goods, and booming productivity across industries. People had jobs, wages were up, stuff was cheap. For the first time, people were buying cars, radios, fridges, washing machines. Modern life had arrived. Things were going suspiciously well, maybe too well. Investing became America's national sport. Everyone was jumping into the stock market like it was a guaranteed way to get rich. People were borrowing money to buy stocks. There were no rules about insider trading, fake companies, or price manipulation. No one checked if the company you bought stock in actually existed. It was a casino. Then came October 1929. People realized they were investing in magic pixie dust. They started panic selling. The market lost nearly 90% of its value over the next few years. Banks failed. Businesses closed. Millions lost their life savings. This crash triggered the Great Depression, one of the darkest economic periods in modern time. Creation of regulations and SEC. Now, to prevent another disaster, Congress stepped in. First came the Securities Act of 1933. It forced companies to tell the truth about their financials when selling stock. Then came the Securities Exchange Act of 1934. It created the SEC, which stands for the Securities and Exchange Commission, a government agency to oversee markets, enforce rules, and protect investors. Today, if you want to invest in a company, you get real financial data, verified reporting, and equal access to information. You can still make risky bets under this, but now at least you know if the company actually exists. This gave us two major things. Transparency. Everyone can see how public companies are doing. Fairness. Everyone plays on the same field. Private nature and accredited investors. After the 1929 stock market crash, Congress introduced strict regulations to protect everyday investors. But what if you didn't want to follow those rules? Simple. You avoid the public market entirely. That's where hedge funds come in. Hedge funds are private. They don't raise money from the general public. To invest, you have to be what's called an accredited investor. That's a legal term that basically means you're rich, usually having over $1 million in net worth, excluding your home, or making over $200,000 a year. This is how hedge funds legally avoid public market rules. The law assumes if you're wealthy, you can afford to lose money and don't need the same protections as everyone else. It's basically a legal loophole. How hedge funds operate. A hedge fund works like this loosely. Wealthy people pool millions of dollars into a partnership with a fund manager. The manager takes that money, says, "Trust me, bro," and heads off into the financial wilderness for a year or two. Nobody really knows what they're doing, not even investors. There are no daily updates, no public reports, and no real oversight. Then hopefully, the manager returns with more money than they left with. Hedge funds aren't just buying and holding Apple stock, hoping the new iPhone will perform well. Hedge funds can bet on interest rates in Japan, the collapse of real estate funds in China, or the spread between oil and natural gas futures in Texas. They invest in assets most people can't access. Private loans, distressed companies, rare artwork, niche real estate deals. These are not your Robinhood-style investments. Secrecy and liquidity issues. Unlike mutual funds, hedge funds don't have to tell you what they own. There's no obligation to disclose what they're buying, how much they've bought, or when they've sold it. They don't want competitors copying their trades. If people know a hedge fund is buying a specific asset, the price could spike before the fund finishes buying, hurting their performance. Then there's liquidity. When you invest in a hedge fund, you can't just pull your money out anytime. Most hedge funds have lockup periods of 6 months, a year, or even more. That's because they often invest in illiquid assets. If everyone withdrew their money at once, the fund might have to sell assets at fire sale prices. Fee structure, 2 and 20. At the heart of almost every hedge fund is the 2 and 20 inches fee structure, 2% management fee. Regardless of performance, this is paid annually. 20% performance fee. If the fund earns profits, the manager takes 20%. If a hedge fund manages $1 billion, the 2% fee alone brings in $20 million a year, even if the fund loses money. Managers take 20% of profits in successful years, making hedge funds lucrative for managers almost regardless of outcomes. Enjoying the video so far? Drop a comment below with your thoughts or questions. We'd love to hear from you. And while you're at it, don't forget to like, subscribe, and tap that notification so that you never miss out. Criticism and performance issues. Hedge funds have come under criticism, especially recently, when many have failed to outperform simple index funds. Investors question why they pay high fees for potentially worse returns. The high watermark rule tries to make this fairer, saying a fund manager cannot collect performance fees again until the fund regains its previous peak after a loss. However, the management fee remains regardless of performance. Why do the rich still invest in hedge funds? Despite risks, high fees, and inconsistent performance, hedge funds still attract the ultra-wealthy. Here's why. Exclusive strategies. Hedge funds trade complex, private market opportunities. Asymmetric risk. Opportunities where you risk $1 to make $10, rarely available publicly. Convenience. Wealthy individuals delegate portfolio management, networking and social capital, access to relationships, insider deals, and elite circles. Diversification. Strategies uncorrelated with the broader market. Cultural mystique. Hedge funds hold a certain prestige portrayed as financial elites' tools. Segment 10. Legacy, power, and conclusion. Hedge funds offer strategic control over capital not available through basic investments. They align with estate planning, geopolitical bets, and philanthropy. Being part of a hedge fund ecosystem means wealth creation behind closed doors. Originally, hedge funds reduced risk, a clever idea from a sociologist who wanted to balance fear and greed. But now, they operate in a world most people never see, with fewer rules and higher stakes. They can win big or lose big. Yet money keeps flowing in. Hedge funds aren't about returns alone. They're about access to where bigger deals happen. For most investors, public markets remain safer, regulated, and transparent, a result of lessons learned the hard way. If you found this video helpful, make sure to like, subscribe, and tap the notification bell so you never miss our latest uploads.